If you own an ETF, you don't own a company. You own a system. Understand that system, and investing gets much simpler. ETFs sound complicated, but they exist for one reason: to make investing cheaper, simpler, and less risky for normal people. Over the next 10 minutes, I'll explain exactly what an ETF is, how it works behind the scenes, and when it helps or hurts you. Let's start with the simplest definition possible. An ETF, or exchange-traded fund, is a basket of assets like stocks, bonds, or even commodities like gold that trades like a single stock on an exchange. Think about it this way. Imagine you want to invest in the 500 largest companies in the US, the ones that make up the S&P 500 index. In the old days, you'd have to somehow buy shares in all 500 of those companies, one by one. It would be a nightmare of complexity and fees. With an ETF, you buy one single thing with one ticker symbol, and you instantly own a tiny piece of all 500. It's the difference between buying every single ingredient for a cake individually or just buying the whole cake. The ETF is the whole cake. And just like a stock, you can buy it at 10:15 in the morning and sell it at 2:30 in the afternoon. Its price ticks up and down all day long, giving you complete control. You can have a basket for the total stock market, a basket for international stocks, a basket just for bonds. Instead of buying hundreds or thousands of companies, you buy one ticker. So that's the what. But what about the why? Why were these things even invented? Well, they were created to solve a very real problem. Before ETFs, the main way for a regular person to get this kind of diversification was through a mutual fund. And mutual funds had some serious drawbacks. First, they only traded once per day after the market closed. So if the market was crashing at noon, you couldn't sell your mutual fund until the end of the day, by which point you had no idea what price you'd get. Second, the fees were often incredibly high. You'd pay sales charges, management fees, marketing fees, all of which ate into your returns. And finally, you often didn't have a clear, up-to-the-minute picture of what you actually owned. ETFs flipped all of this on its head. They trade instantly, so you have control. The fees, especially for funds that just track a broad market index, are incredibly low, and their holdings are transparent. You can see exactly what's in the basket every single day. The first major ETF, the SPDR S&P 500, launched back in 1993, and it started a revolution. ETFs exist because most people were simply overpaying for access to markets. If this explanation is already clearer than what you've heard before, subscribe. This channel breaks finance down without the nonsense. Now, let's get into the slightly more technical part, but I'll keep it in plain English. How do ETFs actually work? How does the price of that ETF on your screen stay locked to the real value of the hundreds of stocks inside it? It's all thanks to a clever behind-the-scenes process called creation and redemption. The ETF provider, think of a company like Vanguard or BlackRock, actually owns all the underlying assets. They hold the shares of Apple, Microsoft, and all the others. They then issue ETF shares, which are basically claims on that basket of assets. Here's the magic part. A group of very large financial institutions called authorized participants can swap assets back and forth with the ETF provider. If a lot of people want to buy the ETF and its price on the market starts to drift a little higher than the actual value of the stocks inside, these big institutions will step in. They'll go out, buy up all the actual stocks, hand that basket over to the ETF provider, and get brand new ETF shares in return, which they can then sell on the market for a tiny risk-free profit. This constant arbitrage is what keeps the system honest. This is why most ETFs don't drift wildly from the value of what they hold. It's a self-correcting machine. So we know this mechanism keeps the price stable, but what makes the price move in the first place? It's really two main things. The number one reason is that the value of the assets inside the basket changes. If the 500 stocks in an S&P 500 ETF have a great day and their collective value goes up by 1%, the ETF's price will go up by about 1%. It's that direct. The second, smaller reason is simple supply and demand for the ETF shares themselves during the trading day. If a lot of people suddenly want to buy a specific ETF, its price might tick up slightly before that creation and redemption process kicks in to balance it out. It's a critical distinction to make. When you buy an ETF, you're not betting on the ETF company itself. You're betting on the contents of its basket. An ETF is just a wrapper. The value comes from what's inside. Okay, let's talk about one of the biggest benefits, reducing risk. We've all heard the word diversification, but ETFs make it practical. If you put all of your money into one single stock, you have one single point of failure. If that company makes a bad decision, if its industry gets disrupted, if it has a scandal, your entire investment could be wiped out. An ETF, on the other hand, spreads your risk across dozens, hundreds, or even thousands of different assets. The failure of one company becomes almost a rounding error. What you get in return is less volatility. You avoid those catastrophic stomach-churning losses. The trade-off is that you also give up the chance of a single stock skyrocketing and making you rich overnight. ETFs don't make you rich overnight. They are designed to help you avoid getting wiped out while your money grows steadily over the long term. Another massive advantage is cost. This is a point that cannot be overstated. Most broad market ETFs charge incredibly tiny annual fees called expense ratios. We're talking about fees as low as 0.03% a year. That means for every $10,000 you have invested, you're paying just $3 a year for the management of the fund. Compare that to older mutual funds that might have charged 1% or more. That might not sound like a huge difference, but fees compound against you over time. That 1% fee over 30 years of investing can consume nearly a third of your potential returns. A third! Lower fees mean more of your money stays invested, working for you. Fees are one of the very few things you can actually control in investing, and choosing a low-cost ETF is one of the most powerful moves you can make. Now, ETFs are a great tool, but people still make mistakes with them. One of the most common is buying too many overlapping ETFs. Someone might buy a total stock market ETF, an S&P 500 ETF, and a large cap growth ETF. They think they're diversified, but what they've really done is buy the same big tech companies 3 times over. More ETFs doesn't automatically mean more diversification. Another mistake is chasing niche or trendy ETFs, funds focused on robotics or cannabis or some other hot sector. These can be extremely volatile and are often more of a gamble than a sound investment. And finally, some people get tempted by the fact that ETFs trade all day and try to day trade them. This usually just leads to higher transaction costs and bad emotional decisions. The action for most people is simple. Fewer, broader ETFs usually win in the long term. So, are there times when an ETF is actually a bad idea? Absolutely. If you are an investor who loves the deep dive, who wants to research individual companies and have precise control over which ones you own, then an ETF isn't for you. You should just buy the individual stocks. They're also not ideal if you're trying to make short-term speculative bets on market movements. There are other financial tools for that. But the most important reason an ETF might be a bad idea is if you don't understand what it holds. If you buy an ETF tracking some obscure index of foreign companies using complex derivatives, you're not investing. An ETF you don't understand is just disguised gambling. In the end, ETFs aren't exciting, and that's the point. They turn investing from a game of guessing into a system. It's a system for capturing the return of an entire market, for diversifying your risk, and for keeping your costs incredibly low. If you understand what's inside the basket, the rest is just patience.